Welcome to the Explainer. Okay, let's talk about something that sounds like it's straight out of a movie, a tax raid. You know, a knock on the door, and it's the tax authorities ready to search the premises. It sounds intense, right? But it's all governed by a very specific set of rules, and today, we're going to break down the official playbook, Section 132.
So what really goes down during one of these things? You might picture doors being broken down and chaos everywhere, but the reality is actually a super structured process. There are clear rules, strict timelines, and specific rights for everyone involved. So if you've ever been curious about how it all works, you're in the right place. We're about to walk you through it step by step.
All right, so here's our game plan for today. First, we'll cover who actually has the power to authorize a search, then what happens during the raid itself. After that, we'll follow the journey of any seized assets, figure out how you can get them back, and finally, look at how the whole thing gets settled. Let's jump in.
Okay, first up, who can even greenlight a search? Because every raid has to start with one very powerful piece of paper, the search warrant. And that warrant doesn't just appear out of thin air. Let's look at the decision makers behind it.
So this isn't a decision made by just anyone. The power to issue a search warrant is reserved for the absolute top brass in the tax department. We're talking about very, very senior officials. Director generals, chief commissioners, commissioners, basically the big bosses. They're the only ones who can sign off on something this significant.
And a search is never, ever random. Think of it as the final step after a long investigation. The authorities need to have what's called a documented reason to believe. And this isn't just a hunch, you know? It means they have solid grounds. Like maybe someone has been flat out ignoring official requests for documents, or they have a credible tip that someone's hiding undisclosed assets, like cash or gold.
All right, Section 2. The warrant is signed, the officers are at the door. What happens now? Let's get into the pretty extensive powers they have once the search is underway.
Now this is really interesting. What you're seeing here is basically a visual roadmap of how a search and seizure actually works under the law. It lays out the whole procedure from the moment they enter to the final seizure, all based on the official rulebook.
So once they're on site, the officers have some serious authority. They can enter and search pretty much anything. Buildings, cars, boats, you name it. If a door or a safe is locked and the keys aren't available, they can break it open. They can search any person who's there, and this is huge in the digital age, they can require you to give them passwords to your electronic devices. And of course, they can seize documents, cash, jewelry, anything that could be evidence. They can even call in police for backup.
But, and this is a really important but, there's one thing they absolutely cannot seize: a business's inventory. You know, their stock and trade. This is a massive protection because it means the business isn't forced to just shut down. It can keep its doors open and keep operating, even while the investigation is happening.
Okay, so what if they find something they need to seize, but it's like a giant piece of machinery in a factory? They can't exactly stuff that in a bag and carry it out. That's where something called deemed seizure comes in. The officer just issues an order on the spot saying, "This is seized." So even though the item hasn't physically gone anywhere, it's legally locked down. The owner can't move it, sell it, or do anything with it.
Okay, on to part 3. The search itself is over, the officers have left, but for anything that was seized, a whole new process is just kicking off, with its own set of strict procedures and deadlines.
And believe me, there are deadlines. The department can't just hang on to these assets forever. Within 60 days, they have to hand everything over to the assessing officer who's actually in charge of the case. Plus, they can also provisionally attach property during the search, which basically freezes it for up to 6 months, so it can't be sold off while they figure things out.
So this brings us to the question you're probably asking, right? How do you get your stuff back? Well, let's dive into the process for getting seized property released.
Well, turns out the rules are different depending on what was taken. For stuff like books and documents, they're generally released within 30 days after the entire tax assessment is finalized. But for valuables, like cash or jewelry, it's a whole different process. The owner has to formally apply to get them back, and that application starts a totally separate countdown.
120 days. Remember that number. Once a formal application is made to get valuable assets back, the department has a strict 120-day deadline to return them. This is a super important right for the taxpayer because it ensures their property isn't just held in limbo indefinitely.
And get this, what happens if the department seizes more cash than you actually end up owing? Do they just get to keep the extra? Nope. They actually have to pay you interest on any excess amount that gets returned. The rate is 0.5% per month, simple interest. It's a way to make sure they're not incentivized to grab more than they need.
Okay, we're at the last section, the final settlement. We've gone through the raid, the seizure, and the return process. Now, let's see how the seized money is actually used to pay off any tax liabilities.
There's a very clear pecking order for how the money is used. Think of it like a waterfall. First, it's used to clear any existing tax debts you might have already had. Second, whatever's left is applied to the new tax liability that came up because of the search. And finally, if there's still anything left over after all that, it goes right back to the owner.
And this isn't just an internal policy. This is backed by a major court ruling. A landmark case established that the tax department can't just sell off assets based on a rough estimate of what's owed. No way. They have to complete the full assessment, determine the final liability, and only then can they start adjusting the assets to cover the bill. It's a huge protection.
So there you have it, the tax raid, from the initial warrant all the way to the final settlement. It's an incredibly powerful tool for tax enforcement for sure, but as we've seen, it's also wrapped in a whole system of rules, deadlines, and taxpayer rights. It's all about checks and balances. So the big question is, do these rules strike the right balance? It's definitely something to think about. Thanks for joining me on The Explainer.